Hello and welcome to this beginner's guide to exchange traded funds or ETFs. This is a third in a three-part series looking at ETFs. In this video, we will explore the top dividend ETFs. In the first two parts, we explored ETFs overall as to which ones are the best ones to invest in, and ETFs by sector, so looking at the best ETFs by sector. A word of caution. Do not take this video as investment advice. I am a random bloke on the internet providing a summary of my research based on a couple of decades of experience. But please do your own evaluation before investing your hard-earned dollars. Before we get started, please also consider subscribing or liking this video, as it really helps get the channel out to more people. Right, don't you love all of those people bouncing around the internet talking about how much money they've just made investing in a stock that was always a no-brainer and guaranteed to go up? And yet somehow that lucky cat of yours hasn't quite picked the right stock for you to make a big noise about. But let's face it, you don't want to invest your hard-earned savings in a stock that some random bloke on YouTube has picked out. You'd rather invest in something a little safer, something that'll grow over time, something that'll provide you with a regular source of stable income, a dividend ETF. So what exactly is an ETF or an exchange traded fund? How different is it to a stock? Well, it's a bit like grocery shopping. You're not quite sure about which brand to pick. You don't want to pick just one item or one stock. You want to try it all. An ETF is like picking a whole basket of different items. If one item has gone off, it's not the end of the world. Yes, you've lost a little money, but you can still make a great dinner. So it's a great way to diversify your risk and reliance on just one single item or stock doing really well or badly. But which specific ETF should you buy? There's literally thousands to choose from. Now I have three selection criteria for you to consider when you're buying an ETF. Number one, low fee. Even a small 0.5% difference could make the difference between a good and a great investment. Number two, choose something that's very liquid. That is traded quite frequently in the market. When you eventually want to sell, you want to make sure there's enough volume of transactions that are happening so that people will buy the ETF when you're selling it. Number three, if you want to be really safe, choose a large fund. In part because it's a seal of approval from a large number of investors. Now, before we get on to our list, I really need you to pay attention to what I say over the next 60 seconds. You may forget the entire video, but the next 60 seconds are very important if you are a dividend investor. You need to make sure you do not fall into the value trap, that is being blindly attracted to the highest dividend yielding ETF or stock. There are three things you need to remember. Number one, high amounts of debt. So that is where the total debt is more than the total equity, or being significantly higher than industry. Now, more often than not, when that happens, as soon as times get tough, that company will cut its dividends. Number two, low or little or no cash flow from operations. The high dividend may be because of a high one-off unusual items that is not a result of the core business. For example, they might have just sold off a subsidiary and used the proceeds from that to pay a dividend. Again, that's not sustainable. Finally, dividend per share is more than earnings per share. So that's where your payout ratio is more than 100%. That essentially means that the company is not generating enough profits or earnings to pay for those dividends. So if any of these indicators are true, it may indicate that those incredible dividends will drop very soon because there just isn't enough real value in that company or ETF. So with that warning in mind and out of the way, and with our three selection criteria clearly defined, let's get back to our top 5 dividend ETFs. At number 5, it's iShares HDV. This particular ETF tracks Morningstar's Dividend Yield Focus Index, which essentially comprises of high dividend paying US equities. So it contains about 75 very carefully selected stocks. Companies like Exxon, AT&T, Johnson & Johnson, Verizon, Pfizer, Cisco, Merck, and so on. It's in the top 5 because many of these companies should actually do pretty well as the economy starts to open up from the pandemic. Fees are quite low at about 0.08%, and the fund size is $6 billion, so quite large. It has also had 4 years of dividend growth, which is quite impressive. At number 4, it's Vanguard's VYM. With a dividend yield of 3% and a 5-year return of around 50%. This one tracks the FTSE High Yield Dividend Index, which again consists of companies that pay dividends that are generally higher than average. Unlike the HDV, this one contains hundreds of stocks. Half of its assets are in financials, consumer staples, healthcare. And again, as the economy starts to open up, these are sectors that you'd expect to do pretty well and start outperforming. So they're companies like Johnson & Johnson, JP Morgan, Bank of America, Procter & Gamble, AT&T, Pfizer, and so on. The fund has quite a low expense ratio at 0.06%, and is quite large with assets of $34 billion. The fund did not have any dividend growth last year, but you'd hope that as we start to reopen, that would improve next year. At number 4, it's Vanguard's VYM, with a yield of 3% and a 5-year return of 50%. This ETF tracks FTSE's High Dividend Yield Index, which consists of companies that generally pay dividends that are higher than average. It contains hundreds of stocks. Half of them are in financials, consumer staple, and healthcare sectors. So again, as the economy starts to open up, you would expect these sectors to start to outperform. There are companies like Johnson & Johnson, JP Morgan, Bank of America, Procter & Gamble, AT&T, Pfizer, and so on. Expense ratios are quite low at 0.06%, and assets are at $34 billion, so quite a large fund. It did not have any dividend growth last year, but again, as the economy starts to open up and as these companies start to outperform, you would expect that to change next year. At number 3, it's again Vanguard's VIG, with a yield of 1.6% and a 5-year return of 86% in total, so nearly doubling your money. The fund holds nearly 200 of the top dividend stocks from the NASDAQ US Dividend Achievers Index. So these are companies that have a record of increasing their payout for at least 10 years. Companies like Microsoft, Walmart, Visa, Comcast, McDonald's, Procter & Gamble, and so on. The fund is biased towards the larger stocks, so it's perfect for investors who are looking for low risk and also an ETF that provides decent growth. Expense ratio is quite low at 0.06%, and assets stand at about $52 billion, so quite a large fund again. It has had a year of dividend growth, and you'd hope that that continues going forward. At number 2, it's iShares DGRO, with a yield of 2.1% and a 5-year return at 85%. This ETF tracks Morningstar's US Dividend Growth Index. In fact, 90% of securities are invested there. It's again a diversified, broad market index that represents around 97% of the market capitalization of publicly traded US stocks. Again, quite a large portfolio of stocks within the fund, nearly 500 of them, which makes it quite a diverse fund with companies from a range of sectors, such as Microsoft, Apple, Johnson & Johnson, Chevron, Verizon, JP Morgan, and so on. Fees are quite low at 0.068%, and assets are quite large at about $10 billion. It has had 6 years of dividend growth, which is pretty impressive given everything that we've gone through over the last 6 years. At number 1, and my favorite, it's Schwab's SCHD fund, with a yield of 2.8% and a 5-year return of 88%. This particular fund tracks the Dow Jones Index. 90% of its assets are invested there, and essentially measures performance of high-yielding stocks by companies that have a record of consistently paying high dividends and have strong fundamentals. It contains about 100 stocks that have nearly 10 years of dividend growth and a minimum capitalization of about $500 million. No stock is more than 5% of the total funds, and no sector is more than 25% of the index. So this strict qualifying criteria makes it quite a safe and diversified bet. Companies include Home Depot, Exxon, Intel, Pfizer, Pepsi, Coca-Cola, and so on. What I really like about this ETF is that it gives decent growth while still churning out a stable dividend. A high return below average risk. Expense ratio is at 0.06%, and assets are at $21 billion. It has had 3 years of dividend growth, which is pretty good. So there you have it. In summary, my top 5. I hope you found this analysis useful. If you did, please consider subscribing and smashing that like button. Thanks again for watching, and I look forward to having you at my next video.